Welcome to Beyond Four Walls, Conversations on Affordable Housing. I'm David Dworkin, President and CEO of the National Housing Conference, the nation's oldest and broadest affordable housing coalition. Here, we'll dig deep into the pressing topics of housing in America. And while we do that, we'll also get to know some of the people who've devoted their lives to seeking tangible, impactful, and achievable solutions. In today's episode, we welcome industry stakeholders who engaged in a panel about mortgage servicing tactics to keep families in their homes. We had this conversation at NHC's 2023 Solutions for Affordable Housing convening on December 7th. What follows is a condensed version of this discussion, with the complete conversation available for viewing at nhc.org.
Thanks everybody for joining us today. I'm Teresa Dumais, Vice President of Government Industry Relations at Freddie Mac. We have a pretty tremendous panel. I'm very excited and honored to be sitting up here with the three of you. This is housing sustainability, navigating economic challenges for homeowners. And we have Eileen Tu, right to my left here. She is the Vice President of Mortgage Product Development and Credit Policy for Rocket Mortgage. David Batney, he's the Executive Vice President of Capital Markets for Guild Mortgage. And then last but not least, we have Giselle Roget, the founding principal of Overbrook Square Group, a Washington, D.C. based public affairs firm focused on the financial services and housing sectors. So why don't we jump right in and talk a little bit about what housing sustainability means. And often I think we've thought a lot about servicing and credit policy kind of in boxes, right? Like, okay, this is what's happening here. Homeowners get into a home. Oh, and then there's these other set of policies over here. But in thinking about and talking with you guys, I think housing sustainability has other layers to it and other potential meanings. So, how are we pursuing new homeownership today in ways that are more focused on sustainable, that is keeping borrowers in their homes and homeownership? What is our understanding of the nexus of sort of servicing with origination policies as it relates to sustainable homeownership? And Giselle, I'll start with you.
When we think about sustainability, there's a lot of different ways to conceive of the topic. There's some people that think of sustainability and a sustainable borrower outcome as just that borrower staying in their mortgage. You can think about it in the govy versus conforming space. Sustainability would be conceived as a borrower perhaps graduating from an FHA program into a non-government insured program. But I think that for the purposes of this conversation, when we're thinking about sustainability, we're thinking about a borrower outcome in which they do not lose their home to a foreclosure event and they're able to stay in their home. And so I think starting off from that initial framework, as we're thinking about sustainability, there are two things that are top of mind for me. And one is that sustainability and this whole conversation of sustainability starts with the mortgage at origination. And there's a couple of different items that kind of fall underneath that, largely the disclosures made to the borrower. And two, as policymakers, as industry, we think about, and the way that we think about homeownership policy and the way that we think about the success of our homeownership programs needs to be tied to this question of sustainability, and specifically tied to it in how we measure the performance of our homeownership program. So to that first item of sustainability, and the sustainability question begins with the mortgage at origination, I really tee off on the disclosures made to the borrower. And I think that one of the positive impacts of Dodd-Frank, as well as some of the work that initiated with the Bush administration in terms of simplifying the RESPA and TILA disclosures and combining them on down to today, is borrowers do have a very good picture of what their mortgage expense cost is going to be, and that is key. But I think that one of the issues with when it comes to disclosure and borrowers that we don't have a good handle on is the overall housing expense. And that's because there are two wild cards. And one of them we talked about earlier today, which was insurance and insurance policies and the premium prices going up there. And there really isn't any way to model that or prepare the borrower for that because every company sets rates differently. And the other item is taxes. And again, very local issue there. And then second, just broad topic of this question about sustainability. We just haven't done a good job, I think, as industry or on the regulatory side of actually measuring the success of our homeownership programs in concert with borrower sustainability and homeownership sustainability.
Eileen, in your 32 plus years in this industry and 20 at Rocket in particular, how do you see sustainable homeownership and servicing kind of being a part of that? And what's changed? What's changed since you sort of started early on to sort of now in the space?
I really think there is that ecosystem of, it's not just about in isolation, servicing and all the policies and hopefully it all works. Servicing and loan performance informs origination. It informs origination programs and products. And so when you better understand that, what does and what doesn't work, that helps create the policy up front. It's like this wonderful ecosystem. And I think what's great is that, and we're lucky to be able to service and originate our loans, is that we can tie those performances together and how can we ensure that people are put in homes that they can afford. And so we think about in origination all of the guidelines. It's income, assets, credit, and the property, right? Those are all key factors to think about when you're thinking about, hey, what is it that drives success? What factors should we be looking at? And then ultimately, what doesn't work? And should we be a little more rigorous there? And so I think some of the challenges, though, and I think about back in the day, we've all actually been around forever and a day, is that something to consider is that our socioeconomic landscape looks different. I mean, we didn't have cell phones or anything back in, I don't know, 19 whatever, but yet that's not incorporated really into a DTI. Or if you think about income and gig economy, that was not a thing back in the day where you think about, hey, I can just pick up a drive, I'm an Uber driver, and I could make ends meet by doing some of those things that just didn't exist. And so our policies need to morph with that and understanding and recognizing those things as sources of financial income, whether it's debt. So again, with the outcome of being able to create sustainability.
David, any insights and additions?
I would just add to their two comments. One way we can maybe frame sustainability is the first 5 years of home ownership. And I think it's fair to say that a first-time home buyer really has a math problem during those first 5 years, which is they're in a very tight financial position. They just paid a lot of fees to close a loan, they put down a large down payment, and they have a very scary high monthly PITI payment. From a mathematical perspective, if they got a fixed rate loan, they are in probably the toughest financial position they'll be in. And as each year goes by and their income goes up, hopefully they have a fixed rate loan, so their housing costs stay flat and their income goes up over time. But the first 5 years, their ability to accumulate new savings each month between their monthly take-home pay and their mortgage will be the smallest they'll ever be in life. And whatever cash reserve is very possibly the smallest will be in life. So they're just mathematically in a financially tight position. And during those first 5 years, curveballs will happen. There could be changes to their income or changes to their expenses. And if we can help create a product that helps them survive those 5 years, then I think that product feature will tie into the servicing outcome. So we'll get the right sustainability or servicing outcome by having the right product features to begin with.
So what I'm hearing all of you say is that the upfront products matter as part of sort of the servicing strategy, and you're looking at it all kind of holistically. So how can we start to help the industry wrap their arms around? I mean, I think it's understood in many pockets that these things need to go together. I just don't know if it's talked about, particularly in Washington, in that kind of way, right? It's like servicing policy, credit policy, but how do we start to sort of think about the pipeline for homeownership in a more holistic way. And David, I'll start with you this time.
The pipeline should be holistic in terms of both product and how we service. And so, for example, we underwrite a loan and originate a loan or create the eligibility terms of a product. That's a big starting point. So we should correctly measure the person's residual take-home pay each month to know what their position will be in terms of ability to either have a cushion of cash for surprises or to accumulate savings. In terms of how we look at the borrowers for down payment, there's 3% down programs out there, and we've historically thought that that's very important because it creates emotional equity in the property. I think we should really look at that. Is it better to have 3 points of cash in a down payment, or could that 3 points of cash be in a reserve account for the borrower? And if you look at the VA world, where you have zero down loans, they perform very well because they have residual income underwriting. And so are there things we can learn from the VA world that also could help drive having the right balance and combination of product features? Another fact is there is a strong correlation to the cash reserves a borrower has and what their default rate looks like in those first 5 years.
And I would just add to what David shared about residual income and the VA model. I think that in assessing the borrower's position for sustainability, thinking about their ongoing income is really important. I think that we're seeing some good headwinds in terms of taking into account income streams. So taking into account income streams from rental properties that are attached to the unit, so maybe, an ADU that's attached to the unit. And also we're seeing special purpose credit programs that lenders are using that are taking into account residual income. So I think that's one way to set up a borrower for success at the front end.
Eileen, how is Rocket thinking about this concept of sort of residual income or analyzing income, all, the sort of pieces that David and Giselle just talked about?
Yeah, 100% agree with you that is an industry we need to think a little bit more about. It can be residual. You can call it net cash flows as well, right?
Yep.
As an underwriter, as a former underwriter, you can see everything in a bank statement. You really can. And when it comes to affordable housing, I would consider thinking about different cultures and the way they spend and the way they save can vary across the board. But if you look at cash flows, which is similar, it's the same idea as residual, you can see how much savings somebody actually has at the end of the day. And that really is directly impactful to performance. What I do love is what we're saying is we need to challenge what we are doing today. What we've done before is not going to really necessarily create success in the future. And so the idea of down payment versus reserves, which we've started teeing off, which is better? And I think you might want to pose the question, but
I think you just did.
I just did.
It's true. Well, what is that interplay, right?
That's right.
And we've just, we hear a lot about the importance of down payment, and I think we just heard in another panel the sort of survey that a lender did of first-time home buyers where they said down payment's the biggest barrier to home ownership.
Right.
Is it from your guys' perspective, or is it a little more nuanced than that? How should we be looking at kind of, helping borrowers be sustainable, especially in those first 5 critical years, and thinking about it from this, okay, we're having more conversations about reserves and residual income, more and additional conversations about down payment, but how does that all sort of interplay, and how, especially you guys doing the lending, when you're looking at a borrower and trying to determine their ability to repay and their ability to sort of be sustainable in a home, what does that look like for you guys?
Down payment is one of the largest barriers, and so one of the things that Rocket has done is offer this program called 1+. But it's basically 1% down, and the idea is to say, again, challenging the traditional. People think 20% down, but also 3% down, right? Is the next kind of step, 95% LTV or 97 LTV. But the challenge is really, should you be, instead of burdening the borrower up front by putting more down payment, or do you take that and create more reserves on the back end, to exactly your point, which is save it for a rainy day, save it for the furnace that's going to blow, which I know that does literally happen within 5 years for some bizarre reason. And how can you afford that? I think Urban did a study, and it said that there are 97 LTV programs with reserves versus like a Home Possible, Home Ready without reserves. Which one performed better, right? And so what they found is the ones with reserves, those programs are both 3% down, performed better. Fannie just did a reserve study, and what they found was that if you, there was no difference in the LTV. They found that performance improved 50% of the time if the assets were used for reserves instead of down payment. So I think that's enough to tell folks to say, you know what, we need to challenge ourselves from a program perspective of saying that skin in the game is most important.
David, how's Guild thinking about this?
Very similar. I think what Eileen just said, historically, when you think about down payment and why it's important, you hear the word skin in the game. And the thought is the psychological connection that you have money invested in the property will keep a person to stay in that home when things get tough and they're thinking about, should I fight for the home and stay here or just walk away? And I would argue that if you have a 3% down borrower and you get in trouble the next month, just the transaction costs alone would wipe out your equity. So, that 3% equity, I don't think is going to really be by itself a magnet to keep a person in the home. And if they're in this math problem of, lower reserves, if you take that 3% down, put that as a cash reserve instead, the other argument is, well, the borrower will just go to Hawaii on vacation and spend it that way. Well, they could. Maybe some will, but many won't. And at least if it goes into down, they don't have a chance to have access to that cash, period. If you let them have that cash, you put them in a better position. They have more of a buffer. And I think that's a better chance to help a person get through. And I think a person's creditworthiness has a strong correlation to their income. So I think the idea of down payment we should relook at and look at the VA model as an example of a zero-down program that has very good performance numbers.
We want to make sure that there is a level playing field with all of the mortgage companies that have different programs. So if there are lenders that are affiliated with home builders, they should be able to offer similar programs that lenders who are just IMBs can offer. I think that's very important. And also, I think that when we're talking about down payment assistance, we have to make sure that the borrower isn't having to pay for it in another way with premium pricing, because that's something that we saw in the lead up to the crisis, and it led to many, many problems for borrowers. So we want to make sure that whatever down payment assistance is provided, whatever gifts are provided, that it's truly assistance, that the borrower is not paying for it with, a higher note rate.
Giselle, we've talked about down payment and reserves, and especially this increased conversation around reserves. What about monthly payment level?
Yeah.
And how important is that in the sort of equation of a borrower's sustainability?
Well, this is something where it's coming to light in a major way right now with all of the conversations that we're having about rising insurance costs. And then similarly, in different parts of the country that have experienced rapid gentrification, as well as, an influx of COVID migrants, they've seen increases in their property taxes. And, in the COVID pandemic mortgage program relief, one of the programs that I had the opportunity of working with several states on setting up their programs was the Homeowners Assistance Fund, which provided assistance for a number of different housing expenses, not just the mortgage expense. And I think that this is one of the challenges. If you are a lender, you're going to have to advance those taxes and insurance. And if you're a borrower and you miss your insurance payment, and stop paying, you could have your lender put a forced place policy on you, which very quickly could become, unaffordable. And so this is one of those issues where I think borrower education is going to be very key, but it's an issue where at the federal policymaking space, our hands are very limited. Insurance is regulated at the state level, and then similarly with property taxes, local property taxes, it can be very challenging to provide any relief to those homeowners who are experiencing challenges in meeting their property tax obligations, particularly from the federal government.
Eileen, we've talked about borrower education, and I know that's something that you're really focused on at Rocket. And I think something that we saw kind of come out of the response to the pandemic, a tremendous amount more communication, I think, than maybe we saw in the wake of the financial crisis. Can you talk a little bit about your approach to borrower outreach, education, both on the front end and on the sort of servicing side, should borrowers get into trouble? How are you thinking about that with your team?
We learned, especially during the pandemic, how important it was to educate borrowers that what the loss mitigation programs are. What we found is people didn't know the difference between a forbearance, or they didn't know the difference between like a modification. And what we had to do was explain, like, this is the path you would go towards in order to be able to stay in your homes. And so kind of making those terms very simple was very key. And so not only was it education, it was also communication, and quick and often. The third thing that we learned was providing tools 24/7. And so within our servicing platform, offering up educational tools that they can access and understand their programs any time of the day is helpful.
David, what about at Guild? How are you thinking about sort of education and borrower outreach as part of that puzzle piece with sustainable homeownership?
I really echo the comments you both just made. Trust is key. You can build the trust through having a very high quality origination experience, and then in Guild's case, we retain the loans that we originate, and so that you continue that experience. So it's not uncommon if a borrower has a question about their escrow account, they may reach out and call their Guild loan officer who did their first loan, and actually the loan officer likes to take the call because they can they can check into it, solve the problem, answer the question, and that keeps them connected to the borrower. And if you have that high level of trust, the key is when a borrower gets into trouble, you want them to let you know as soon as possible. There's a lot of connection between this. The sooner a borrower contacts their servicer, the better chance you can find a solution that might be more optimal than if they wait too late.
So what can we focus on now, things that are working well that we can continue to enhance to make sure we are even more prepared for any kind of future? And I will say too, I think the industry's response in the wake of the pandemic was pretty tremendous. And I think we at Freddie Mac, we were sort of bracing ourselves at the beginning to say, oh my gosh, are we going to see the wave of constituent cases and other things that may come in like we did in the wake of the financial crisis, and we did not. I mean, I think that's a testament to the tremendous amount of work that the industry had done sort of since the financial crisis to now to really shore up that sort of servicing side, and likely too on the credit policy side, right? Like looking very closely at that. So if you guys had to give advice to servicers, to borrowers about what we should be doing more of, or maybe even doing a little less of in terms of what we could do to continue to strengthen that sustainable piece and be prepared for whatever may come our way down the pike. And I will say, Eileen, let's jump in.
I think one thing to think about when we think about sustainability and servicing programs is to ensure that there's savings. When it comes to, when I say savings, I mean savings in the payment, monthly payment, a payment reduction. We talk about payment relief, right? And so there's reasons why they can't make their payment. And so whatever program is stood up, it should contemplate that.
If you look at what happened during the COVID recession and compare that to 2008, it was a night and day difference. In 2008, if you were a borrower in trouble, you had a really difficult time getting a hold of your servicer. Plus, in 2008, lots of people stripped out equity in the preceding years through lots of repeat refinances. Compare that to the COVID recession, where if you just called up your servicer and said, hey, I was watching the news last night, and they mentioned this thing called forbearance. What is that? you immediately got put into forbearance. Even if you didn't need it, even if you still had your job, you were in forbearance. And so I think for the next recession, the answer will be somewhere in the middle of the two. And for some scenarios, forbearance might make sense, but I agree it won't be across the board. Note modifications, those work well if the note rate you're modifying happens to be above current market. You could do that. That may not be the case in the next recession, or maybe fewer people that might fit that. So I think it'll come down to more tailored solutions that fit each unique person.
I would echo Eileen and David. I think that when we look at the response to 2008 and very high documentation requirements for borrowers to get assistance, those programs did not help very many people. And so we need to balance to make sure that there's not a moral hazard, to make sure that borrowers really do have a financial hardship. However, I think one of the successes of the HALF programs that I worked with is they required borrower attestation of financial hardship. And if they, did not actually face a financial hardship, they could be facing some serious criminal penalties. So I think that having borrowers attest to financial hardship if they are in it in order to receive either a forbearance or other assistance is going to be key. But I think having overly prescriptive programs, overly prescriptive borrower documentation requirements, that is going to both prolong a already bad situation, and it's going to be counterproductive to actually helping keep borrowers in their homes.
How should we be measuring success in the sort of housing sustainability space, thinking about borrowers staying in their homes? What things do we need to take away from this conversation and continue discussing with our industry partners to strengthen housing sustainability for the future in the lens of what success looks like? And Giselle, we'll start with you.
The Federal Reserve Bank of New York has actually done some really great research here, and they've, kind of called out the government for not having a good borrower homeownership sustainability metric for our primary program for first-time homebuyers, which is the Federal Housing Administration. And I think that, as I said before, I think that all of our private and public sector programs to support homeownership need to be linked with homeownership sustainability. And as we're thinking about what constitutes success, again, it's complicated. Some people would say that homeownership has not been sustained if a borrower ends up selling their home and renting. I may have disagreements with that definition, but I think that, again, at a very minimum, sustainable homeownership means that a borrower does not experience a foreclosure event. That being said, I think that as we're thinking about foreclosures, we do need to recognize that distressed properties are a source of homeownership opportunity, and that it doesn't have to be a zero-sum game, that we can have a graceful exit for borrowers that are experiencing financial difficulty that does not result in a foreclosure. You can have cash for keys programs, and cash for keys programs need to be done in such a way that there are a recognition that this is truly a cheaper alternative to foreclosure, and provide some financial incentives for borrowers to pursue that option if they truly cannot maintain homeownership. And again, a recognition that unfortunately not all foreclosures are preventable, I think is also going to be important as we're, having these conversations about sustainable homeownership, and that, as we're trying to provide as many opportunities for borrowers to stay in their homes, also we need to recognize that there does come a certain point where this home is no longer sustainable for this borrower. So how do we make sure that that borrower continues to have access to housing?
David, what about you?
I think how we should define it is expanding the people we serve, addressing the underserved markets, specifically closing the minority homeownership gaps, but doing it in a way where it's not like the pre-2008, like Director Thompson described, but expand homeownership opportunities without putting people in loans where they don't have the ability to repay. In order to do that, I think we cannot use today's existing tools and think we'll get different results using the same tools. And what I hope as an industry that DTI as we know it today is a small or zero part of our future credit underwriting, and that we look at residual income as a much better way to measure a person. With electronic bank data, as Eileen was describing, you can see their actual real take-home pay each month, and you can see their actual real total expenses each month. And Guild, in our servicing portfolio, we looked at 3,000 first-time homebuyer loans we did, and we looked at that data where we had at least 12 months of trended data. And the borrowers who had 12 months of positive residual income, meaning their take-home pay was above their total expenses each month, they had a performance, a loan default performance ratio equal to a credit report, to a good credit score. And so I think by having tools like this that allow us to, in my opinion, more precisely better measure credit risk, we can expand credit because there's, per the Urban Institute, 65% of black adults are below a 620 FICO. If that's the barrier to entry into the GSE products and also in the risk-based pricing grids, that's the bottom of the pricing grid, how is that not a barrier? And whether it's Asian home buyers, whether it's black, Hispanic, or any other underserved community, many of the underserved communities don't have traditional credit histories to the same extent that white borrowers do. And so I think through better means and better measures, we can expand credit and still help sustain people in their home and make sure they're into a very thoughtful mortgage where they can pay.
Eileen, what about you?
I mean, both of you pretty much said it, so I'm not going to repeat a lot of that. But I totally agree about the idea of expanding credit and credit worthiness. And if you think about the term invisible credit, that just, how do we address that, right? Our models today are that you have to have certain data points. And we've proven just in this conversation alone that not everybody has that. And so how do we find those that should have a home, can afford a home? How do we create programs around that? How can we see that? And we have to think about things differently. And then as far as sustainability, it's just ensuring that the programs address the needs of the borrower. And if they are unable to stay in the home, then it's not to say they have to have a home. Maybe their best solution is something else, maybe a more affordable rent if it's out there. And so how do you show compassion and how do you show dignity to borrowers to say, it's okay and let me help you. And so I think that to me would be providing shelter in whichever way you can and doing it in the right way.
So I'm hearing borrower needs first and foremost, residual income, bank statement, basically new and different data points that we need to think about. Reserves are as important as down payment and to make sure that sustainability is there, and education, communication, and trust. So these are the things I keep hearing over and over again. I think it's a good place for us to wrap up. Let's thank our amazing panel. Thank you guys so much.
Thank you for listening to this edition of Beyond Four Walls. You can visit the National Housing Conference at nhc.org. There you can learn more about affordable housing policies, affordability challenges throughout the nation on our Paycheck to Paycheck database, and explore membership in NHC for you or your organization. We appreciate your interest and look forward to working with you in the future. Until next time, I'm David Dworkin, NHC's President and CEO, wishing you a great day.